Hello viewers, welcome to my channel. I'm Hasham Ali Khan. So this is the fourth video on unit number 3, financial institutions and market. In this unit number 3, already 3 videos I have uploaded explaining the meaning of the term money market, what are the features of money market, what are the functions of money market, and organization of money market in India, and lastly instruments used in money market, that is treasury bill and commercial paper. These two instruments I have already covered in the last video. In this video I am going to explain you 3 more instruments which are used in money market, that is certificate of deposit, letter of credit, and banker's acceptance. These 3 instruments I'm going to explain, so watch the video till the end. So if you have not watched the earlier videos, I suggest you go to the playlist of my channel, select the subject financial institutions and markets, watch the video regarding what is money market. Then you will be clear in mind regarding the meaning, features, functions. Then you can be able to understand the instruments which are used in money market. So before explaining, take the screenshot of the points which are written on the board, then I'll explain all the points in detail. So first of all, money market instruments are those securities which are traded in the money market, where the participants in the money market will buy and sell those securities. Those securities are called money market instruments. And money market instrument shows the ownership of the person who owns that security, right? That is money market instruments. The last video I have explained 2 money market instruments which are commonly used, that is treasury bills and commercial paper, CP. Now in this video I am going to start certificate of deposit. This is the next money market instrument. So what do you mean by certificate of deposits? Commonly it is known as CD. The CD is issued by banks. First of all, in the previous video I told you treasury bills are issued by government and commercial papers, CP, are issued by corporates, whereas CD, certificate of deposits, will be issued by banks. And they are very similar to term deposits. There are different types of deposits are there. Term deposits are also called fixed deposit. A person can go to the bank and deposit the money for a fixed period of time, like 1 year, 2 year, 3 year, 5 year, like that. So that is called term deposit. So CD is also just like a term deposit and very similar to term deposit. However, CDs are issued in dematerialized form, and unlike a term deposit, they can be traded in the secondary market. The 2 differences are there between term deposit and this CD. The first is it is in the dematerialized form. Dematerialized form means electronic form. This CD will be issued in electronic form. Secondly, unlike term deposits are not traded in the secondary market, whereas the CD, certificate of deposit, can be traded in the secondary market. Then, unlike treasury bills or commercial papers, the CDs are add-on instruments. In other words, they carry a coupon rate of interest rate. And one more difference between other instrument and CD. In other instruments like a treasury bill or commercial paper, it won't carry interest. It will be issued at a deep discount. For example, the face value of CP is let it be 5 lakh, but it will be issued only for 4 lakh 20,000. And on maturity, 5 lakh will be paid by the company. So no interest is carried on in case of treasury bill and in case of CP. Whereas in case of certificate of deposit, it carries interest on. That means rate of interest is specified. Interest will be calculated on the face value of CD. That is the difference. So what are the main points we have seen? CD will be issued by banks. It is just like a term deposit, but it is in a dematerialized form. It can be traded in the secondary market. It will carry interest. Then features of CD. What are the main features of CD? First of all, CDs are largely issued by commercial banks when the investor deposits money with the bank, just like term deposits. Just like if a person wants to make a term deposit, he goes to the bank and deposit the money for a period of time. Here also, commercial deposit also, a person can approach the bank and deposit the money as in case of term deposit, right? But the difference is it is in dematerialized form. Secondly, CDs are typically issued with a maturity period of up to 1 year. However, longer duration CDs are also issued. So, CDs can be issued for 1 year or any duration. Thirdly, CDs are fixed income securities in the nature of add-on instruments. It's a debt instrument. The interest rate is specified and interest will get accumulated on the CDs. And in other words, investors get back their deposits along with accumulated, interest at the time of maturity. So when the person purchases or invests in CD, the interest will go on accumulate. So at the time of maturity, the investor will get his deposit money plus add-on interest. The complete amount he will get on maturity. Next one is CDs are issued in electronic form, that is dematerialized form, unlike the term deposits which is not in dematerialized form. Then CDs are issued for a minimum amount of 1 lakh, the denomination. You cannot make the CD in any denomination, the denominations are fixed. The CDs can be made either 1 lakh or multiples of 1 lakh. 1 lakh, 2 lakh, 3 lakh, 4 lakh, like that in multiples of 1 lakh, CDs can be made. Next is banks cannot buy back the CD before maturity. Once the CD is issued by the bank, the banker will not take back the CD before maturity. So if you are holding the CD, you can hold the CD up to maturity, or you can sell off your CD in the secondary market, but you cannot return back the CD to the bank. Banks do not offer any loan facility on these instruments. One more feature, no banker will give the loan on this CD because CD is a short duration security. On that short duration security, no loan will be provided. CDs cannot be issued by cooperative bank and regional rural banks. So the government has prohibited against issuing the CD by cooperative banks and regional rural banks, RRBs. So these banks cannot issue the CDs. Other commercial banks can issue CD. In examination, question is frequently asked, what do you mean by certificate of deposit? So all these instruments are very important, remember, frequently asked in examination. So you must know what are the differences and what are the features of every instrument. Treasury bill, commercial paper and certificate of deposit. 3 I have completed. Now I am coming to a very important instrument called LC. Letter of credit. Very often I have seen the question papers, they will ask, explain about the LC, letter of credit. So I am going to explain you in detail. Now, letter of credit are essentially a part of trade finance. This is also an instrument which is used for short-term financing. It is particularly used in international trade. First point you remember, this LCs are used only in international trade, where two parties are located, or two parties are will stay at two different countries. International trade. One party belongs to one country, another party belongs to another country. Importer and exporter. So import and export trade, international trade, these LC will arise. Now, when two parties residing in two different countries deal with each other, they are unwilling to take default risk. What do you mean by default risk? The risk that one party fulfills their obligation but not fulfilled by the other party. That means when both the parties have fulfilled their obligation, it is called executed contract. When one party has fulfilled their obligation, but there is a risk that the other party may not fulfill the obligation. It is called default risk. When two parties are residing at two different countries, then what will happen? They want to trade with each other. For example, an Indian importer wants to purchase a machine from American exporter. So Indian importer is there, American exporter is there. So this person wants to purchase the machine from America. That both of them wants to strike a deal, buyer and seller, but there is a possibility of default risk. One of the party may fulfill the obligations, the other party may not fulfill the obligations. The importer has bought the machinery, but he has not paid the amount. Or importer has paid the amount, but the exporter has not delivered the goods. That is called default risk. So there are chances of default risk in international trade. The importer is unwilling to pay first and take delivery later, as there is a risk that the exporter may not deliver the goods. Simple example, Indian importer does not want to pay first. If he pays first, then there is a possibility that exporter, American exporter, may not deliver the goods. So it will be a loss to Indian importer. So Indian importer does not want to pay first. Then similarly, the exporter is unwilling to supply the goods first without getting the payment, as there is a risk that the importer may not pay after receiving the goods. Same is the situation with American exporter. American exporter says that I will not deliver the goods unless I get the payment, because once if I deliver the goods, there is a possibility that Indian importer may not pay the amount after receiving the goods. So both of them, they don't want to take the risk. Then somebody should come in between to settle the transaction. And a letter of credit removes this barrier to trade, wherein the importer bank agrees to pay for the goods exported provided by the importer. Now see here, in this situation where there is default risk is arising, the importer does not want to pay first and the exporter does not want to deliver the goods first. In that case, the LC will remove this barrier. This obstacle will be removed by letter of credit. What is this letter of credit? The importer banker, the banker of the importer, will give the assurance to the exporter that you deliver the goods, I will pay the amount. If the importer does not pay, I will pay the amount. This is the assurance given by the banker in the form of letter of credit. So a letter of credit, bank agrees to pay for the goods exported provided the importer certifies that the goods supplied were exactly the same as goods imported. So once the importer certifies that whatever goods I have ordered, the same goods have arrived and we have to pay. When one certificate is given by the importer, then LC, letter of credit, will be issued by the banker. This gives assurance to the exporter that the payment will be made. Once LC is received from the importer's bank, then this LC will be sent to the exporter in America. Once the exporter receives this LC, the exporter is sure that definitely I am going to get the amount. There is no doubt regarding receiving the amount. So this LC is a document which is given by the banker. LC is more a service rather than lending of money. However, LCs are used by an exporter to raise funds against the promise of the bank to pay for the exported goods. Actually, when LC is issued, it is in the form of guarantee that the bank is giving the assurance that we will pay the amount if the person does not pay. So actually it is in the form of a service document, but the exporter will make use the document as a financing document. Once LC is received, then it will take some time to get the money. During that period, the LC can be used as an instrument to borrow the funds. That LC can be treated as an instrument in money market. On the basis of that LC, a person can be able to procure the funds, to get the funds. So here, LCs are often discounted and even traded in the money market. Just now I told you. that this LC document can be used as an instrument in the money market for borrowing and lending. That's it. So I have explained you about certificate of deposit. I have explained about LC. Remember, LC is very, very important. Next, last document I'm going to explain is about banker's acceptance. Banker's acceptance is a bill of exchange which is drawn on and accepted by a banker. A bill which is drawn on the bank and the banker has accepted the bill of exchange, that is called banker's acceptance. So this banker's acceptance is also one of the instrument of money market. Banker's acceptance is a bill of exchange drawn on and accepted by the bank. In other words, the bank is committing to honor the bill on the due date. So once the banker has accepted the bill, it is declaring that I will pay the amount of the bill on that particular date to that particular person. So it is simply acceptance of the banker. Banker's acceptance serves the same purpose as letter of credit. However, it is more attractive instrument for trading in the money market as it is unconditional acceptance. So the purpose of letter of credit and banker's acceptance is the same, but the banker's acceptance is more widely used compared to letter of credit because it is unconditional acceptance given by the banker. No condition attached. Directly the banker says we will pay this amount on particular date to particular person. Now, as in case of LC, letter of credit, the exporter uses banker's acceptance by discounting it in the money market. Just now I have given the example of importer in India and exporter in America. So instead of sending the LC, letter of credit, the importer can send banker's acceptance also to the exporter. So exporter can use this banker's acceptance as a money market instrument and can trade in the money market instrument. The banker's acceptance becomes a negotiable instrument as per the person would be willing to buy it because of unconditional acceptance by the banker. Negotiable means transferable. That means this banker's acceptance is a negotiable instrument in the market. It can transfer from one person to another person because it is being accepted by the banker. Now, the accepted bill bears an irrevocable, unconditional guarantee by a bank to pay the bill on maturity. So, this banker's acceptance will have unrevocable, that is irrevocable, unconditional acceptance. The banker has not attached any condition and it is not irrevocable. It cannot be taken back. It cannot be cancelled. Once the banker has given unconditional acceptance, it means definitely the banker is going to pay on maturity. A banker's acceptance is accepted when the bank writes on the draft its agreement to pay it on maturity. The bank becomes primary obligator of the bill of exchange. So when banker's acceptance is given, the banker takes up the primary obligation. The primary obligation is of the banker because they have accepted the bill. There are many types of bills such as trade bill, then finance bill, treasury bill, foreign bill. So many types of bills are there which are issued by the bank. The concept of banker's acceptance and bill discounting is applicable to all such bills. So the discounting, the negotiability will remain same whatever be the nature of the bill, whether it is a trade bill, foreign bill or finance bill, treasury bill, any type of bill, the characteristic features of the bill are same. Now lastly, features of bills of exchange. The first feature is it is unconditional order to pay, not a request. In the bill, it is given an unconditional order. That means the person who draws the bill has given an order on the bank that you have to pay so and so amount unconditionally to so and so person. So the bill does not contain a request, it contains an order to pay. Third, the amount payable should be definite. There should not be any ambiguity regarding the amount. The amount written in figures and words should be same. There should be no ambiguity on the date of payment. clearly the date of payment should be specified in the bill, on which date the amount is payable. The bill must be signed by both the drawee as well as drawer, both the parties. The party who draws the bill and the party who accepts the bill, drawer and drawee, both must sign it. Next one, the amount stated on the bill should be paid on demand or on the expiry of a fixed period. So, maturity. The amount of the bill will be paid either on demand or on a fixed maturity period. So, it should be specified whether bill should be paid on demand or on maturity. Then the amount is paid to the beneficiary of the bill or specific person or against a definite order. So different ways are there how the amount is payable. The amount may be payable to the beneficiary of the bill or to a specific person or to the order of a specific person. Right. That's all. These are the features of banker's acceptance. I have explained in detail completely regarding certificate of deposit, letter of credit and banker's acceptance. These questions are very, very important. My suggestion to you, watch the video not once, twice, thrice. Definitely you can be able to get a good command, and in examination with full confidence you can write. My best wishes are always with you all. Inshallah, we will continue the next topic in the next video.